Hi everyone, welcome to the Fundamentals of Corporate Finance Make It Clear series. In this video, I'm going to show you the technique of solving loan questions. Loan questions are those that ask students to find loan payments or principal amount of a loan. It is a very popular type of exam question in corporate finance or financial management. If you can master the technique of solving this type of question, then it should help boost your examination performance. That's why I make this video to share the technique with you. There are three basic steps of solving loan questions. First, we start with the equation, which equates the loan principal with the present value of loan payments. Just like loan payment should be the future value of a loan principal. Loan principal should always be the present value of loan payments whenever we use the interest rate of the loan to discount the loan payments. We'll use some examples to explain this point later in this video. And then second, in the right-hand side, we determined the correct expression for present value of loan payments based on the pattern of loan payments. Different payment pattern entails different expression. A single loan payment would require a simple PV equation, whereas an annuity payment would require an annuity PV equation, so on and so forth. So the next thing is to determine the pattern of loan payments, set up the correct expression for the PV of loan payments, and then put it in the right-hand side of the starting equation. Finally, we substitute the relevant values into the equation and solve for the answer carefully. Now, let us use some examples to explain why loan principal should always be equal to the PV of loan payments when the payments are discounted by the interest rate of the loan. In example 1, P1 is the principal of a loan to be repaid after one period. R is the loan rate per period, and C1 is the loan payment. After one period, principal plus interest will be P1 times 1 plus R, and it must be equal to C1 because it is a loan to be fully settled in one period. And so we can come up with this equation, P1 times 1 plus R equal to C1. We then divide both sides by 1 plus R, we end up with this second equation. In the left-hand side, we have loan principal, and then in the right-hand side, we have the PV of loan payment. And so we have loan principal equal to the PV of loan payment. The only caveat is that we must use the interest rate of the loan as the discount rate. If we use another interest rate instead, then both sides may not be equal. Example 2 is about the loan to be fully repaid in a series of two payments. P is now the loan principal, with C1 being the loan payment after one period and C2 the loan payment after two periods. In this case, we can think of the total loan amount P as the sum of two smaller loans, P1 and P2. P1 is a one-period loan which promises payment of C1, and P2 is a two-period loan which promises payment of C2 after two periods. We call it equation 1. From a previous example, we know that we can use this PV equation to represent P1. We call it equation 2. Then for P2, it matures after two periods. The principal plus interest for this loan after two periods will be equal to P2 times 1 plus R squared, and it should be equal to C2 such that the loan can be fully settled. And so we can come up with this equation, P2 times 1 plus R squared equal to C2. We then divide both sides by 1 plus R squared, and we will end up with this equation. We call it equation 3. We then substitute equation 2 and equation 3 into equation 1, and we will end up with this equation. In the left-hand side, we have loan principal, and in the right-hand side, we have the PV of both loan payments. And so again, we will have loan principal equal to the PV of loan payments. We can easily extend our examples to any arbitrary number of payments and end up with this equation. No matter how many loan payments we have, we still have loan principal equal to the PV of loan payment, as long as loan payments are discounted by the interest rate of the loan. So the equality between the loan principal and the PV of loan payments is irrespective to the number of payments. It is also irrespective to the pattern of payments as well. In this equation, we have assumed nothing about the relative amounts of C1, C2, C3, or any other loan payments. These payments can be equal. In such a case, we have loan payments in annuity. These payments can also be different too, and some of them can be zero. But no matter what the pattern is, loan principal equal to the PV of loan payments still applies. We have learned why loan principal is always equal to the PV of loan payments. Now let us learn how to apply it practically in tackling loan questions. In question 1, you plan to borrow a $10,000 loan from a bank. Interest rate per annum is 5% with monthly compounding. The loan will be fully repaid lump sum after 2 years. What will be the loan payment? To answer this question, we start with the equation that equates the loan principal with the period of loan payments. So in the left-hand side, we have the loan principal P. And then in the right-hand side, we need to determine the specific expression for the period of loan payments. The keyword here is lump sum. That means the loan will be settled in a single lump sum payment after 2 years. To find the period of a single lump sum payment, the simple period equation would suffice. And so in the right-hand side of the equation, we put the simple period equation here. We then substitute the relevant values into the equation. P is $10,000 and R is the period rate, which is equal to the annual interest rate divided by the compound frequency. So it is equal to the 5% divided by 12. It is equal to 0.4167%. And T is the total number of compounding periods. It is equal to 12 times 2. So it is equal to 24. After substituting all these values into the equation, we should find that the loan payments after 2 years will be $11,049.5. These are the steps for BA2 Plus for your reference. Question 2 is an annuity question. You need a 20-year fixed-rate mortgage loan of $500,000 to buy a property. Mortgage rate is 3% per annum with monthly payment. Find the monthly loan payment. Again, we'll start with the equation that equates the loan principal with the period of loan payments. So in the left-hand side, we will have loan principal. And then in the right-hand side, we need to determine the specific expression for the period of loan payments. The question just states that the loan payments are monthly without further details. And so we'll assume the following automatically. First, the monthly payments are equal. Second, they are paid at the end of every month. In other words, the loan payments constitute an ordinary annuity. That's why we should use the PVRA equation to represent the period of loan payments in this question. So we put the PVRA equation in the right-hand side of the equation. We then substitute the relevant values into the equation. First, P is equal to $500,000. R is equal to 3% divided by 12, so it is equal to 0.25%. And T is equal to 12 times 20, so it is equal to 240. After substituting all these values into the equation, we should be able to find that the monthly loan payments should be equal to around $2,800. These are the steps for BA2 Plus for your reference. Question 3 is a sequel to question 2. Based on the terms of the loan in question 2, we know that we need to pay $2,800 per month. But we cannot afford that amount. We can only afford to pay $2,500 per month. And we know that it is not sufficient to pay off the loan at the end of the loan term. And so we offer to pay off any remaining loan balance at the end of the loan term in a single balloon payment. So the question is, how much is this balloon payment? Let us use a timeline to illustrate this question. Right now, we'll borrow $500,000 from a bank, and we will pay $2,500 per month in between. But for the last payment, on top of the $2,500 payment, we also need to pay a single sum of payment so that the loan can be fully settled. This single sum of payment is the balloon payment. It is called balloon payment because it is typically much larger than the monthly payment, and so it is like a balloon flying high to the sky. No matter what the payment pattern is, we still start with the equation that equates the loan principal with the period of loan payments. But now, as the loan payments are composed of the $2,500 monthly payment and the balloon payment, the expression for the period of loan payments will be composed of two parts accordingly. The first is the PVRA equation for the $2,500 monthly payment, and the second one will be the simple PV equation for the balloon payment. We then substitute the relevant values into this equation, and we should be able to find that the balloon payment is equal to $89,622.5. We have used 3 different questions to illustrate the technique of solving loan questions. I believe many of you should be able to master it now. Alright, that's all for this video. Thanks for watching and see you next time.